Forecasting coverage charges within the U.S. has been a venture in current quarters, after the aggressive financial policy tightening stabilized with rates at 5 cents. This become due to giant volatility in each boom and inflation expectancies. In fact, from overdue 2023 to early 2024, after a chain of decreased than predicted inflation prints and weaker GDP boom, markets started to weigh an aggressive timetable of charge cuts. At height dovish expectations in January, markets had been pricing close to 200 foundation factors BPS in coverage rate cuts for this 12 months. However, situations modified markedly in the course of the 12 months as 3 consecutive months of high inflation prints fueled issues concerning the disinflation direction. This, along better boom expectations, brought about a large repricing of short-term hobby charges, which had been then predicted to stay higher for tons longer. A few analysts and buyers even taken into consideration the possibility of, in addition, price hikes to prevent a sustained reacceleration of inflation. After the modern-day spherical of inflation scare, softer information for boom and inflation in current weeks are suggesting that the United States Federal Reserve, Fed, need to begin slicing costs faster in preference to later, kickstarting the financial policy easing cycle. In our view, the Fed can have room to reduce fees at a quicker tempo than markets are presently looking forward to, especially subsequent year. 3 predominant elements preserve our outlook. First, the disinflationary trend inside the U.S. is unbroken and could accelerate in addition over the coming quarters, accomplishing the Fed's 2% target earlier than previously predicted. The disinflationary trend has been grounded on supply chain normalization, a moderate slowdown in monetary activity, and tighter monetary policy. Core non-public intake costs, PCE, inflation, which excludes risky expenses consisting of strength and meals, fell to a brand new low of 2.6% in June, the slowest pace in extra than 3 years. Importantly, safe haven inflation, the primary element sustaining center inflation, is about to decelerate in addition in the coming months, as moderating condominium charges are gradually integrated into new contracts. This can assist to cow the proverbial final mile hole among the strolling inflation rate and the inflation goal, giving the peace of mind that the Fed desires to adjust its route. 2D, softening labor markets recommend no longer handiest a lack of greater structural price pressures from wages, however also even a potential sharp deceleration of financial pastime. Main labor-related gauges and surveys, inclusive of the Task, Openings, and Exertions Turnover Survey, JOLTS, the ISM Employment Indices, and the Small Companies Survey, point to quick deteriorating labor situations. Temporary employment, for example, is contracting, a condition that generally takes place only for the duration of financial recessions. The unemployment price has long passed up sharply from 3.4% in April 2023 to 4% in June. But excessive frequency facts from the Kansas City Fed suggest that the unemployment price should technique 5% over the approaching months, a way surpassing the anticipated balanced complete employment price of 4%. Third, the document financial tightening cycle has left actual hobby costs at overly restrictive stages. The actual interest price adjusts nominal interest rates by the extent of inflation and consequently reflects the actual hurdle charge by means of contemplating modifications in the fees of goods and services. Real interest charges impact purchaser spending, financial savings, and funding selections, and therefore have an effect on overall financial activity. A nominal policy interest price of 5.5% presently implies a real fee of interest above 2%. All in all, we count on the Fed to cut rates by means of 25 BPs twice in 2024 before accelerating the tempo of fee cuts in H1 2025. That is because of the continuation of the disinflation trend, a rapidly deteriorating labor market, in addition to the need to normalize particularly restrictive real rates.